Every collaboration starts with an introduction, a moment in time where the stars align at the right place, at the right time, and with the right people. It's the connections we make with one another that form the foundation upon which we build our future. Put simply, it's the start of something new. And when we take those first steps toward positive change, toward our hopes and dreams, we treat the connections we make with care. Because with years of experience, we've learned that the path we choose is not nearly as important as those who walk it with us. No matter the end goal, the trust we choose to put in others is the biggest investment we can make for our future. The Capricorn Group has been walking beside dreamers since 1982, connecting them with the right people and solutions to turn their ambition into opportunity. And it all started with an introduction. Capricorn, we are stronger together.
Hello, ladies and gentlemen. It's me again. Yes. Thank you. Welcome once again to Capricorn Group's Inspire session. Can you believe that it's our 14th session over a span of 5 years? So we're really building up our Inspire Thought Leadership brand, and thank you for being here. This session today is titled Smart Money Moves. And thank you for joining us here in the room, face-to-face, as well as our online guests. You're very much welcome. Now, for our first-time guests, our group's Inspire sessions are thought leadership information sessions that are geared towards stirring up important conversations in the communities in which we operate. And that's how we remain true to our purpose of leading through financial services and being connectors of positive change. Now, we all know that creating financial security requires an understanding of savings and investment concepts and strategies. And for those unfamiliar with investing, knowing where to start or how to continue can be a challenge. That is why Capricorn Group, together with Capricorn Asset Management, today present an introductory discussion on saving and investment, specifically catered to first-time and novice investors. This session is presented by a lovely panel of investment specialists from the Capricorn Asset Management team. Floris Bergh is a chief economist and a member of CAM's Economic Committee. He has 31 years of industry experience and holds a BCom Honours in Economics from Stellenbosch University. He is also a chartered financial analyst, that's a CFA charter holder, an NSX qualified stockbroker, and an accredited personal financial advisor. Shuutheni Shivute is a portfolio manager at CAM with 3 years industry experience. He holds a BCom Honours in Economics from the University of Pretoria and is a CFA Level 2 candidate. Elina Shikomba is an institutional consultant at CAM with 3 years industry experience. Elina holds a BCom Honours in Financial Economics and Investment Management from the University of the Free State and is a CFA Level 2 candidate. Now, ladies and gentlemen, we aim to keep improving the financial literacy of the communities in which we operate by driving key discussions and equipping people. That's our employees here in the room, our current and potential stakeholders and partners, as well as our lovely students in the room, to make complex financial decisions, sufficiently plan ahead, and improve their understanding of investment concepts. Thank you for joining us here today, and please help me welcome Shuutheni Shivute, Floris Bergh, and Elina Shikomba. Ladies and gentlemen, Elina will be driving our discussion, so we're pretty excited for that. And we will pose questions also in between the conversation. Thank you.
Right. So firstly, I just want to welcome the crowd once again, and just a round of applause to just thank you for coming and joining us today. So when I first started earning my first salary as a student tutor back in university, Savings and investing was the last thing on my mind. Honestly, I was more focused on living in the moment, as I took a very you only live once approach when it came to my finances. Not once did it actually cross my mind to put money aside for a rainy day or actually just invest and open an investment account, something that I have regretted till today. I then eventually started my savings journey by opening a savings account, which is the 32-day deposit account with a bank. And as admirable as this was, because, well, I was finally putting money aside, this wasn't the right tool to start my journey on building and creating wealth. So it took me quite a while to realize that setting aside money doesn't necessarily mean that you are investing, and that at some point that I had to open a unit trust account, which is now my investment account. So before we start, gentlemen, I just want to pose a few questions to the crowd. Who here has a savings account? Just quick raise of hands. Right. Who here has an investment account, or rather a unit trust account? Okay. We can stop here. Yeah. I just want to ask, who knows the difference? Does anybody just want to quickly volunteer, just quickly explain? Ma'am in the back? Let's just wait for one of the assistants to just hand you a mic. That side.
Can we, in the meantime, ask what school are these guys from? Say again? Hey, give a hand to our school people.
Yeah. May we please ask that you just stand for the camera, ma'am?
Thank you. With the little knowledge that I have, a savings account is when you it's an account that you open at the bank, where you transact on your daily lives when you're taking out money and so forth. And how I think I understand it is the savings account at the bank does not really earn interest because the money in there is not being invested. While the unit trust is, your money is invested in, depending on which fund that you are investing in, on which that the unit trust is. So your money is actually getting exposure to equity and all that. So that's the difference, and that's how I understand it. Thank you.
Thank you. It was actually a very spot on. It was a very spot on explanation on the difference. Floris, do you mind just elaborating a little bit more as to what exactly is savings and what is investments and the difference between the two?
Yeah, it's in my mind, I think we would all agree, savings, the concept, and investments as a concept are largely, to a large degree, interchangeable. In other words, some people will think about savings as putting aside money regularly to build up a investment account. And then you will distinguish perhaps and say the investment side of things could come into play once you need to decide, like the lady said, which funds or what asset class would you like exposure to. That's an investment decision. But also, normally when one has built up a bit of a nest egg, or you have some wealth already, so you're starting with a significant amount, then the decisions you make can be called more directly investment decisions. Because then you have to decide, okay, how do I go, where do I go with this million and that million and so forth. Exactly. So,
for those that have millions.
What do you guys think? Should I?
Yeah, I think Floris actually has it quite spot on. They have a lot of overlapping characteristics between savings and investments. I would characterize savings more as that flow, that monthly from your paycheck that you're putting away, that amount, whether it's in your savings account to build it up, and then once you have enough money in your savings account to go and open your unit trust account, because they also do have minimum amounts for you to open, then that is now your investment decision. As Floris had said, whether you want exposure to your equities or bonds, and that is all also now driven by your risk tolerance and risk profile. And I think that's, we'll cover that in the life stages.
In the life stages.
Of
Maybe
investment.
I can just quickly to link with the answer we had just now. If you have a savings account at a bank, it's not completely correct that you don't earn interest. That is what the bank is for. The bank pays interest on savings, but mostly it's fairly lowish, and you won't get interest perhaps really on your transactional account. So you might need to make a distinction between the account you use every day and a savings account, which is separate. But on that, you will earn interest. And on the interest you earn there, you will have a withholding tax of 10%.
Yeah.
Same with money market unit trusts.
Taxable.
So, Floris, seeing as we have quite an audience that's quite young joining us today, is there, just a quick question, is there a specific age where you should start saving? So is it that I should start saving when I'm 30, when I'm 25, when I'm 35? Like, at what age should one actually start considering that, okay, you know what, perhaps I should put money aside for
I would
a rainy day?
say, at about 6 months old.
The sooner the better, definitely.
Yeah, because the thing is with investing or saving is your best friend is time. That's your best friend. So the earlier you start, the better. Once I landed in the investment arena, I started to make calculations about how rich I could have been at 25 if my dad saved X amount since I was born, you know? So it's a real thing.
Yeah.
Where
Yeah.
I think the people that start a savings account for their kid once they're born, be it a savings account, be it a unit trust, be it a study policy, those people can be very proud of themselves because it's an excellent decision that makes all the difference to the child's life, especially when the child becomes like of age.
Yes.
Yes.
So, yeah,
Okay. So the earlier the better.
earlier the better. But look, if I can maybe I should do this example here.
Okay.
Huh?
Yep.
So this morning when I couldn't sleep, I made calculations. So I think even the children, the school guys, everybody should understand the concept of 10%, right? 10% of something is easy to calculate. Okay. So I said, okay, if you can invest in a solution, whatever the solution is now, be it life insurance, bank account, unit trust, whatever it is, you invest with it, and you get a 10% return on your investment, okay? And you start with $1,000 NIM a month, okay, when you're 6 months old. Then you put your $1,000 NAM a month away for the first year, and then in the second year you increase your premium, or let's call it a premium, right, by 10%. So every year you increase what you put away by 10%. So there's two 10%ers now. It's the return you get on your investment and the 10% increase that you put on your premium. Then, after 20 years of doing this, let's guess how much will you have?
Anybody from the audience want to take a chance? Come on, I see so many bright faces here.
An
There must be
educated
one.
guess
Take a guess and win a
from
pen.
one of our young scholars, perhaps.
There's a nice gift that you might win.
What do you guys think?
Anyone from Hage Geingob?
Let me put us out of our misery. It's 1.6 million.
It's a
The
lot
power
of
of
money.
compounding.
And I mean, this is Excel spreadsheet, né? You
Yeah.
can't fault the Excel spreadsheet.
Yeah.
Yeah. On the Excel spreadsheet, we're all millionaires.
Yes.
But no, jokes aside, it goes to show how important it is if you invest for the long term. And you make small changes per year. And then obviously you get the 10% return, which is not too demanding. It's not out there a 10% return. It is sort of in the middle of the pack. If we can perhaps call it this way and say, in the investment world, you've got asset classes, right?
Yeah.
And you start with conservative to very aggressive. So conservative would be the funds that Shu runs. He actually manages the portfolio that invests conservatively. So here we pool people's individuals' contributions, and then he goes to the bank. Instead of us going to the bank as individuals, he goes to the bank with $1 billion. So the bank pays him more interest on the portfolio than the bank would pay me on my call account. Nee? You will get 3.5 or 4% on your call if you're lucky.
Yeah.
But if he goes to the bank, he gets a better interest. So
7%.
okay, so that's conservative to aggressive.
Yes.
Out there in the aggressive world would be cryptocurrencies.
Yes.
Yeah.
Okay, so what we're talking about here is a middle of the road type investment. So yeah, just as a feeling, just to get across what is possible.
Yes. Well, Floris, you hit us with so many big words here and millions and billions. But let's just circle back to investing and what, since we've covered savings now, let's just really get into what exactly is investing, because I know a lot of people have this mindset that A, investing is usually a get-rich-quick scheme, and B, that it's usually for the rich. So the common misconception that's out there is that, well, you probably need to have a couple of millions to start investing. And if you don't have a couple of millions, just chuck it away in a savings account. So, Shu, do you mind just elaborating what exactly is investing and what is it not? Just so before we lose our crowd.
So I think Floris did touch on it. It's very important to start at a young age. The sooner, the better. So investing is not something that will make you rich overnight. I think it is more of, it will protect your wealth, it will build your wealth, but it also takes a lot of discipline. You know, if I come back to Floris's example, you know, you have to make that savings or that deposit into your investment account on a regular and like timely basis. So you don't skip a deposit because you know you need to do something. So that discipline must be there. And once that is there, I think your money can definitely work for you over time. So investing is essentially putting your money in an asset. You're buying an asset for yourself, that this asset will either increase in value or it will generate income for you. That income may be in the form of interest. If it's an interest-bearing asset, that's a bank deposit now will earn interest, for example, or in the form of dividends. Dividends are paid, stocks, equities will pay dividends and distribute income to the holders of that share. So that is the purpose of investing, because you want to make the money grow. You want to satisfy future you. 10 years from now, you need to look back and say, yeah, this was a good decision. This money has worked for me. I've kept it here, and it has grown to such a point where you can now use it for what you intended it for. Because once you start investing, you know, you need to have a plan, a goal. And you also need to look at your current situation, where you are, your current assets, your current liabilities, your income, your age, your ability to take risk, and then with that information, you can then decide which asset class you'd like to invest in. whether that now is equities or bonds, and it's across that spectrum that Floris had mentioned, you know, where you can either be very conservative if you don't have a high risk tolerance, or very assertive if you're very young and you have a lower risk tolerance.
Sorry, Shu, do you mind just elaborating a little bit more as to what is risk tolerance exactly?
Risk tolerance,
Please.
okay. So, I mean, every day when we define risk in the office, we think of standard deviation. That's now to quantify statistics.
That's volatility.
Volatility, yes. But a layman explanation is it's how your investment, right? So risk is your ability to tolerate a change in value of your investment and the magnitude of that change. So the larger the magnitude of that change and the more likely it is to occur, meaning that that value is relatively volatile, then you can define this as being a high-risk asset or asset class. So if the value of investment is more stable, it's more predictable, because a deposit, you buy it and you're going to earn your 7% interest, so you put $100, at the end of the 1 year you have 107, you know, you're guaranteed. But with equities, for example, you can buy your Amazon share, but you never know what's going to happen. COVID came along, market crashes, and the value of investment decreases. So risk tolerance is your ability to stomach that change in value of your investments.
If I can add to that, perhaps the risk story is it's both your ability to take risk. So let's say if you have 10 million in wealth, your ability to take risk is high because you're unlikely to lose a substantial amount of your wealth, whatever you do. Well, okay, not really, but you understand what I'm getting at?
Yeah.
But when you're retiring and you're 60 years old and you only have 1 million or 2 million,
Okay.
then your ability to take risk is very low. But apart from the ability to take risk, which is based on the actual wealth, it depends on your willingness to take risk. Because some people are willing to bet their whole pension fund, you know, on someone that comes along and tells them they can get 50%. Then they bet all the savings they did over their lifetime from pension fund, they put it in there. And that still happens today. So their willingness is high because they want to double their money, but their ability is low. So if I'm not mistaken, we've got a risk questionnaire on our website.
Yes, we have the pocket risk tool. So it's a questionnaire on the CAM website, cam.com.na. Go on there and it'll ask you a couple of questions around your age, your investment goals, level of income, and there are a couple of questions around your ability to take risk and your willingness to take risk. And then it'll formulate with all your answers, and it'll advise you on which of our funds or products will suit you based on your risk profile. So it is there, and I think you should all go have a look and try it out.
Right. So, Shu, right at the beginning, you mentioned that when you start investing, it's very important to have a plan.
Yes.
Do you mind just explaining what exactly this plan needs to entail? Or like what factors do I need to consider exactly?
Yeah. Okay. So the first step, so I'll put this in 5 steps, is evaluating your current financial standing. This entails looking at your current level of income, your age, your and what you dependents and so forth. Yes, exactly. Then the second step is, you need to define what you want to accomplish. Are you saving to buy a new car, or the saving to put down a deposit for a new car? Are you saving for deposit for a new house? Is it savings to go on holiday, or is it savings for your children's university? So there are many reasons why we do save, but you need to now, clearly now, know why you are doing this or investing your money. Third step would be, how much risk can I take? And I think that is also a very, it's a function of your age, you know, how much risk you're able to tolerate. So the younger you are, the more risk you are able to tolerate because your investment horizon is generally much longer. The older you are, the less risk you're able to tolerate because now you are about to start using that money you've invested and saved. So you want a safe, conservative investment. Fourth step would be to decide, and it feeds out of the third step from the risk tolerance, is what investment do you want to make or are you able to make? So if you have a higher risk tolerance or ability to take risk, you would then invest in a riskier asset class. Or if you have a lower risk tolerance, in a more conservative asset class. Or you could blend the two and build yourself a portfolio of 50% risky, 50% less risky, or 60-40, just to find that right balance. And finally, once you've made your investments, do not forget about it. You can't just put your money there, look the other way, and you know, you need to monitor your investments, you know, look at it, come back and see that. Because over time, your risk profile does change. Because you would be young maybe when you started and you're able to take a lot of risk. And over time, you'll rebalance your portfolio and then move it towards a bit of a more conservative stance, for example. And it's very important to protect yourself. Yeah.
Great. So let's really get into these steps. So with step one, assessing your current financial situation. What exactly does that entail?
I think you mentioned most of it.
Yes, I did.
It's just so one thing that you also mentioned that's important to highlight is a question of this being disciplined, because bless you. We are normally, if you ask most people, you know, do you have money to invest? They say, no, I don't have money to invest. My expenses are too high. I've got children, I've got food to buy, I've got a house to pay, I've got all these things. So I think what you said is important, is to what savings and investments actually entail is the foregoing of current consumption or current needs. You forego something in order to have a future need met.
Yes.
So it is a challenge to start a disciplined investment plan, because you need to actually perhaps cut from some other expenses, mostly from, let's say, entertainment or expenses that are not basic needs. So that takes quite a bit.
But on that, Floris, how do you exactly decide what to cut on? Because, you know, in a world where you have so many expenses and you have so many things that you need to pay, whether it's varsity fees, petrol, diesel that's just gone up the other day.
Are you talking about my, you saw my budget.
I saw your budget, yes, Floris, I was very worried.
Varsity, diesel.
So how do you navigate, how do you decide, okay, this is what I need? Is there something that can aid me in deciding as to what exactly I need to cut back on in order to increase my savings?
I think that you mentioned the 50, 30, 20 principle.
Yes.
Yeah, okay. Well, in an ideal world, that is more or less a rule of thumb that you can think about. Try to do your basic expenses and living expenses 50% of your income, and then let's say 30 or a third of your income on life That's not basic needs.
Disposable income, so to say.
Yeah.
Sorry.
But
just
save
for
at
the
least about
audience,
20%.
can we just tap into what disposable income is? Because our audience is very young, guys.
It's what's left after you've paid taxes.
Taxes.
Yeah, it's what's left after your necessities, your covering your rent, your petrol, like you mentioned.
Burner
your-
Boy tickets.
That falls into the disposable income category. So
okay.
after you've made all your important payments and saved 20%, then you're left with your 30% disposable, which you can then go to the movies, buy mom a gift on Mother's Day, stuff like that. Okay. Exactly.
But I think we can all acknowledge and say that in life that is a very difficult thing to do. But it is necessary because people sometimes they get to a retirement age say, sorry dat ek nou oor retirement altyd praat, because I'm close.
Yes, I was going to say you at that age, so.
And then you say, but I've been a member of a pension fund my whole life, and it's not enough. You know, people don't think about how much you need. They just say, oh, I've been a member whole life, they're going to take care of me, I'm fine.
Yeah.
Where the amount that you decide on, the 20%, if you want to call it that, you need to have in mind the type of a yeah, thank you. Where you need to get to provide, when you mentioned that we started to use the funds.
Yes.
So I said time is your best friend, because the earlier you start, the better. That's undeniably true. But you also need to have some sort of idea about the quantum that you would like to reach. And if your pension fund is likely to be insufficient, you need to make more provision. So for those people that don't have a pension fund at work, if you're self-employed or you're commission-based or whatever the reason is, you're not a member of an official pension fund, there you can do retirement annuities, right? Retirement annuity is a private pension fund, which most of the big institutions provide for. So most people need to supplement their pension fund contributions with something more to get to
An additional
sustainable
investment.
level
Yeah.
post-retirement. Yeah.
Something that I found is that personally, the 50-30-20 principle is a very important tool when it comes to actually budgeting for your savings or budgeting for your savings. So planning out how much you can actually afford to save and put away, because you want to build that nice consistent cash flow into your investment account or your savings account. Because when I first started off, and I'm not sure if anybody can relate, when I decided, you know what, I need to get my life in order, the first 3 months I would put away large chunks of money that I couldn't afford. I couldn't afford to put that much away. And then by month 4, I'd be like, oh no, I'm broke. And then I'd lower it. And then by month 5, it's just nothing. And then I'd be like, what's the point? And then it's this constant cycle. So if you properly plan out how much you can actually afford to save or invest consistently, it will help you build this nice consistent cash flow, as I mentioned, when it comes to your savings or investment account. But before we move on to the next step, which is defining your financial goals, I just want to ask, is there anyone from the audience that has a question or two regarding assessing your current financial position, or just maybe a thought that someone would like to share? Yolanda.
I think the pocket risk tool that we had mentioned on the CAM website, it's a very good tool to help you with that first step, to evaluate your current standing, because it does ask you some questions. Maybe you wouldn't want to necessarily share them with everyone or person, so it goes into the computer and it then kicks out, the funds that are best suited for you. But in that, the questions that it asks will help you evaluate that current standing, that level of income, what debt, the level of debt you have, the assets, whether these assets are generating income for you or not, and then that'll help you, just to see where you currently stand, yeah, and how much you're able to save.
Yeah.
Yeah.
So moving on then to defining your financial goals, I've come to realize that when you decide that you want to invest or when you want to put money aside, it's always to determine what exactly, and I'm sure Floris can agree with me, what exactly your end game is. What do you want to achieve after your investment period?
The question I get the most from people, once I tell them I'm investments, I manage, we portfolio manager. What is the best investment to do now? Wat kan ek nou koop? Wat? Nee?
Yeah.
Dan sê ek, wat wil jy bereik? Nee? Well, what do you want to achieve with your investment? No, I just want to make money. It must make the most money the quickest and so. And then I said, yeah, well, buy Dogecoin.
Yeah.
If you bought Dogecoin a week ago, you would have made 80%.
Yeah, beautiful.
Just on an Elon Musk tweet.
Tweet, yeah.
I nearly said tweet. Elon Musk tweet. But yeah, so that's aside. So if you wanna do that sort of thing, buy crypto or try and trade it. What I always say is, what is the best car to buy now? What's the best car to buy? BMW. But what if you want to go camping?
Hilux Bucky.
Exactly. So the same thing with investments is, what is the need you're trying to address? Is it a Ferrari need or a BMW need or a Bucky or a tractor or a bus or a, there's this whole range of needs which you say now it's very important to understand what your risk profile is and what the goal is and what is the time horizon that you're going to invest for and what is the tax implications. Very important to take into consideration whether what you are going to do now, is it taxable or not. So, for instance, if you invest in direct property, the rent you receive is actually a taxable income. I don't know if people realize that.
Yeah.
Yes.
Yeah.
That is correct.
So, yeah, but obviously the expenses you go is deductible on the direct property. So, yeah, tax is an important consideration.
Okay. So you mentioned your time horizon, and I guess this will take us automatically to step 3, is that once you determine your objective and what you want to achieve, then you can effectively determine your time horizon and your risk. So I guess we covered so much on risk as to how to determine your risk tolerance, but can we just quickly touch on how do you mitigate risk? So let's say I have a very low risk tolerance, and does that automatically mean that I cannot invest in, let's say, riskier assets like international equity, or can I pair it with something less risky? Is there a way that I can mitigate my risk tolerance?
I think there's more than one way to mitigate your risk. And I think the first one is to diversify your investments. Don't put all your eggs in one basket. So perhaps if you're looking at asset classes to invest in, you would say, I'll take a bit of the conservative money market, so a larger chunk of the conservative funds, a little bit of the moderate funds, and even a smaller bit of the assertive funds, to diversify your portfolio. Or you can mitigate that risk by simply investing in a conservative asset class. I think with that, then you know that your investment, you know what interest and levels of interest you will receive at the end of your investment. So with the risk mitigation, diversity is your friend.
Diversity, yeah. It's a saying, never put all your eggs in one basket.
But if you do, watch the basket.
What? Always keep an eye on the egg.
That's what Warren Buffett says. Put
So-
everything in the basket, but watch the basket.
Always watch the basket.
But that is the most, the most thing that most of us, as normal people, our investments are like, investing in something. You've got a portfolio manager that runs it for you, and you don't to worry about it.
Yeah.
You just
As
need
long
to
as she
trust.
works there, I know I'm fine on investment fund.
Yeah.
But if you want to take risk yourself, then you need to watch your basket.
Yeah.
A mistake I learned when I invested in Tesla. But moving on, let's just quickly delve into step 4 as to deciding what to invest in. I think just for our audience and for a little bit more clarity, can we just give a brief definition of what's the difference between real assets and financial assets?
Okay. I'll take that one. Real assets and financial assets. So a real asset is something that is tangible. You can touch it, you can pick it up, put it there. So an example of a real asset that you could invest in is, for example, a rental property, a second flat, for example, that you would rent out and then earn that rental income. Would be an example of a real asset. Or land, if you want to buy land or something. Or even your car is a real asset, although it's a depreciating asset, so I wouldn't advise it as an investment vehicle. And then you have your financial assets, which also can be divided broadly into your listed and unlisted assets. So this is now under financial assets. So listed would be your stocks and your bonds and your treasury bills that are usually listed on an exchange of some sort, whether it's Namibian Stock Exchange, South African Stock Exchange. These assets usually are more regulated because they are listed on a public platform where they trade, where you and myself can go and buy them. So there is a certain level of certainty with regard to the information that comes around these assets. Then you have the unlisted side, which is more giving loans to private companies, debt. So if you happen to have opportunity to give a private company a loan, for an example, it's that company is not listed on an exchange somewhere, so the reporting requirements may be a little bit less. So you may need to do a little bit more research on this sort of assets and to know what you're getting into, because there are some risks that you may not see or are not clear at the moment. So that's the main difference between your real assets and your financial assets. Yeah.
So-
I think, a real asset you can also maybe call commodities.
Commodity, yes. That's true.
If you're prepared to keep gold under your bed, then I guess that's a real asset.
Yeah.
Or what's the word? Livestock. You
Livestock,
mentioned land.
yes.
Livestock
that's
is a legitimate good investment to make if you can, because the biological unwas.
Canvas.
You don't get that sort of growth somewhere in investment market.
Oh, they grow
financial
very
assets.
quickly. Yes.
Yes.
Okay.
The
Multiply.
biological growth.
Okay. Yeah,
So
that's
yeah.
true.
Okay. Circling back to financial assets, let's just quickly touch on unit trusts, because weirdly enough, a lot of people think all unit trusts are the same. So, Shu, do you mind just giving us a brief overview as what exactly are unit trusts and just the different types of unit trusts that are out there?
Okay. So unit trusts are pooled investment vehicles in that they gather the money of individuals like yourselves, corporates, entities, and then we pool those funds and we then invest the funds in a certain asset class. So why it's actually called a unit trust is because when you're investing in this fund, you're actually buying a unit. So it's unitized, and that unit has a price. That is where you get your value from. And that price is a function of all the underlying assets. All the assets minus the liabilities and costs is the value of that unit, divided by the number of units in the fund, of course. And that unit will give you the value and exposure to that specific asset class. So there are a range of unit trusts that range across a risk spectrum, if we can put it that way. Starting on the conservative side, money markets, and then more moderate is your bonds, and also your managed funds. So these is a combination of your very assertive equities that I didn't get to yet, and your conservative bonds and or money markets. That's your managed funds. And then on the assertive end of the spectrum, like I mentioned, is say your listed equity, whether it's your local or international. And then on your far end of the spectrum, I think you have listed property. That's also quite risky.
Yeah.
And then your cryptocurrencies and your less regulated financial assets.
The meme stocks.
The
Meme stocks.
Flavor of the month stocks.
Exactly.
Yeah.
I would put property not so far out,
Not so far.
listed property. Because listed property is like a hybrid between what we talked about, the real assets and the financial asset.
Yeah.
Because what you buy is you buy a share, but of a business that owns real assets. That's the property companies. Now, that has had a big hiding now for 2 years, but over the last 12 months or more, it's actually recovered very well. So that's also an option.
What would you say are the pros and cons associated with investing in unit trusts? Are there any cons?
I would say, can I start with something?
Yes.
So
please do.
firstly, it's liquid,
Okay.
which is actually a two-edged sword. It makes it possible for you to withdraw your money overnight. So all unit trusts are supposed to be able to give you your money within 24 hours. So whatever unit trust you're in is very liquid, which is good in a certain cases, and there's no penalties. So if you withdraw from it, you sell at that price that he said. But that also means people tend to use the money because it's you can get it quickly and it's liquid.
Yes.
So that's the one, and it's regulated, highly regulated. There's unit trust legislation which we need to comply with. There's a trustees, there's a portfolio management company and portfolio managers, and it's a publicly accessible information, etc. So it's transparent. What the people can maybe look out for as far as unit trust go, if you can get onto the internet, is to look for fund fact sheets, as we call them. It's like a one-pager that gives you a good summary of the fund, what it does, what's the point of the fund, what's the returns, and what's the costs, and etc. etc. So it's very open, it's very transparent.
Yeah.
That's what I can think of.
Yeah. I think there are more pros than cons.
Definitely.
In all honesty, yeah. I think, very liquid, very safe, and a big pro is that, they are investment professionals. We work with these instruments and assets on a daily basis. We evaluate, we sit together, and formulate a strategy that will try and maximize your return as an investor, And whereas if you were to go and do it on your own, which you can, you can go to a broker, and or even Easy Equities has made it very a lot easier now to gain access for you to buy your own stocks, build your own portfolio, trade currencies, and so forth. But when you do it on your own, you need to be very cognizant of the risks and be aware of what you're doing. And the benefit of putting in unit trust is that we go to work every day to try and maximize your return and make sure your investments are safe. And you can sleep sound at night knowing that, you won't wake up and the price of that unit will be zero all of a sudden,
The professionals have it covered.
Yeah.
Definitely.
School children, perhaps. You can actually study portfolio management.
Yes.
It's actually a real thing.
Yeah.
Yeah, you can study it as a subject.
Yes. It's a question. Sorry, ma'am. Let's just wait for the mic. We're having problems hearing you. And do you mind please standing up? Thank you.
Can you guys just tell us what are the different type of unit trusts?
Okay. So I think Shu touched on that a little bit. So I know there's your fixed income unit trust and your equities, and then you have your balanced funds, which is a mixture of two, which I personally think is a great way to mitigate risk, and because you put in such a nice diverse bundle. Floris and Shu, perhaps you guys would like to elaborate a little bit more.
Maybe you could talk about your fund, the funds you manage, actually.
Yeah,
Okay.
the fixed income funds.
That's in the conservative space.
Yeah.
All right. So if I were to touch on that, so the different type of unit trusts, you have now on the very conservative side, your money market unit trust or money market funds. So these unit trusts have a mandate to go and buy either bank deposits that will earn interest. So we buy in bulk. So that allows us to get a better rate of interest from the bank. Or they go and buy treasury bills, which are issued by the government, Namibian and South African government. I think there are also promissory notes, but those are less common. These are all your money market instruments that are, you're guaranteed. When you buy it, you know what you're going to get at the end. And then moving a little bit to more risky end of the spectrum, a little bit more risky, is now your bond fund. Or let me start with your income funds. So your income fund has corporate and government bonds. It'll hold those assets and bank deposits and treasury bills as well. But the term of the assets is generally a little bit longer, and that will earn you a little bit higher interest for that longer investment. Then you have your pure bond funds. This fund just has bonds, no money market instruments like bank deposits or treasury bills. So the bond fund at Capricorn Asset Management mainly invests in government bonds, Namibian and South African government bonds. And you can, these are a little bit more assertive than your money market funds. And then that's where I work, and that's the space I manage. Then my colleague, his name is Yaku, he now manages more on the equity side of things. So your equity unit trusts will either now go invest either in your local equities. When you mean local, it's mainly South African and some Namibian. And then all your international equities, that is now offshore.
So with equities, we mean shares.
Shares,
Shares.
yes.
Yeah,
Stocks.
shares in business.
Exactly, yeah. And then we also have a fixed income Capricorn Global High Yield. So this is investing in bonds that are offshore, basically, in America and European markets. And then you have your managed funds, which is a combination of now your main asset classes, your bonds, your local equity, offshore equity, and money market. And they package it in certain percentages. So if you have a higher percentage of your risky asset class, then it'll tilt more to the risky side. If you have a higher percentage of your conservative asset class, then your managed fund will be a bit more conservative. Okay, I hope I've answered your question. Thank you.
So there's a range of funds. And typically, what you ended up with the managed funds, they are mostly also similarly invested to what your pension fund would typically look like. So if you're a member of the pension fund, your pension fund invests diversification, and the managed funds of the unit trusts would be similar to what the pension fund is invested as. Yeah. And then there are more conservative balanced funds where you have a bigger, more diversification and less of the higher risky asset classes.
Yeah. I think that answers.
We must speed up, I see.
We have one more
Oh,
question.
sorry. Shu, you mentioned you briefly spoke about buying assets directly. I just want to quickly ask, when it comes to, like, let's say I have enough money, let's say 75,000 invested, saved up in one of my unit trust accounts, and I decide, you know what, I want to buy a bond and I want to buy it directly. How does one go about doing that? Or let's say I'm a pensioner, not believable, but I received my pension payout and I've decided, you know what, the best way to go about this is buying a bond, let's say an inflation-linked bond, perhaps. How does one actually go about buying a bond? I mean, we know that bond auctions them off, but how do you buy a bond?
Okay. So stocks and bonds, the easiest way to actually buy them is through a broker. You go, you sit with your broker, you ask them to buy you the specific bond. They will go and either buy it for you in the secondary market, or they can go to a primary auction. So the Bank of Namibia, usually once a week or every second week, they have auctions where main institutional bidders, mainly institutional because of the volumes they bid, are very large. They come and they bid, and the government will then allocate and fill the bids, starting from lowest to highest. So that is, and you can actually partake in those through the bank. So if you go to your bank and you ask them, can you please bid for this bond for me, this amount, then they can do that for you. But there are costs involved, which you have to be cognizant of. And the other thing is you must know the risk associated with that financial asset you're buying. That's very important. Because if you buy something and you don't understand the risks that are associated with it, you can have unintended consequences that can harm your investments and detract and actually reduce your overall returns. Then you leave you off in a worse place than where you were initially. So it's very important. If you're doing it on your own, please do your research, do some reading. You can even come talk to us and ask, and we'll be happy to have a chat with you. Yeah.
Or essentially also seek out a financial advisor. Just ask, pick their brain, have a question or two as to what are the risks associated with the different instruments.
Sorry, are we in question time now or not? I see there's a question there.
Oh, yes,
Yes,
please.
But wait for the
Just wait
microphone.
for the microphone.
Should we just go into questions now?
We need to sum up cryptocurrency. I'll briefly.
May I please ask to explain the difference between an investment account and like stock exchange and forex trading? Because whether you can explain whether they are in the same category, like and if they are in different categories, is forex trading more risky than investing your money in an investment account? Thank you.
Yeah, by investment account is basically a generic word that we say this is an unit trust, like we sell, for instance, or a policy product or a account at a stockbroker or something like that. So it is an investment-related account, but trading in currency and crypto, that sort of thing, for us lies out there. It's like it's a weird and wonderful space where people can make money, but 99% of people lose money there. But it can be done.
That's extremely risky.
Yeah.
Yes.
Good morning. I just want to find out if you can explain the difference or what it is when you're buying into government bonds and treasury bills. What are you actually buying into?
Okay.
It's IOU.
Yeah.
The government promises you.
You're giving a loan to the government,
That's
essentially.
It. Yes.
There you go.
And then they are paying you interest for that money. So the way a bond works is that you earn interest in the form of a coupon, which is paid out twice a year. And the second component of the bond is actually the price, the face value. So that price itself can fluctuate as well. So you can buy it at a discount, say $80 with a face value of 100. And at maturity, you will get your 100, and between that point in time, you'll get your interest payments as well. A treasury bill is more of a, it's a discount instrument, that's what they call it. So you are gonna give the government $90, and in 1 year's time, you're gonna get your $100 back. You're not necessarily actually earning interest. You buy it at a discount. That's a treasury bill.
And the treasury bill is also shorter term.
Yeah.
Shorter
So
term.
And
up to a
bond is
year.
usually quite
Max
longer.
term.
So, but yeah, what you do is you lend money to government. So there's usually a budget deficit. I'm all aware where, like many of us, our finances are in a deficit. But the government also usually have a deficit, and that deficit has to be funded. So they borrow from us, the people. They borrow money via CAM or the banks or the insurance companies or the individuals. So yeah, they borrow money. The treasury bill runs up to a year. You can have a 3 months, 6 months, 9 months,
12 months.
12 months. That's
Exactly.
treasury bills. And then the bonds are just longer term. It starts from 3 years now.
Well, yeah, 2 years. I think
GC.
the shortest one is
2
almost a year and a bit, up to 35 or.
So those are
Yeah,
normally,
yes,
when you
very
hear a
long.
GC30 or a GC25 or a GC27, those are the bonds that mature in those years. And then you get your payments twice a year, ne?
Yes, your coupon payments.
Payments, yeah. It's a bit tricky to understand, but let's not go into it now.
Yeah, I think you have one more question. I'm gonna
Thank
go
you.
back. Okay.
So I had two questions. The first one was, why do you have to go through a broker to buy a bond or stock? Why can't you just go directly to the issuer? And then the other thing was, I think like a couple of weeks ago, I was at a public lecture, and the guy kind of showed how our debt was growing, but our GDP was going down. And my question is, does it make sense to buy Namibian bonds now? Because usually I hear that bonds are so safe, especially like US bonds, but if you're buying bonds from a country that's kind of going through difficult economic times and its debt is growing, it doesn't make sense to buy bonds from such a country.
Okay, let me make a few comments on the budget. You can comment on the direct approach of the assets.
Okay.
So yeah, I must admit, we have been fairly concerned about Namibia's state finances, government finance position, but not that worried that we wouldn't buy them. What you have seen is the yields that people demand for buying the bonds are very high. So it's very attractive actually to lend money to the Namibian government at the moment. Because on a 10-year view, you get 12% per annum. On the GC50, 4550, you run at 15%.
Yeah.
So you can just buy that and go to bed and say, that's fine. Because it's an excellent return over a 30-year period, 15% per annum. But the people, generally speaking, I would say the also public have been very worried. Ne? But after last week's medium-term budget, medium-term update, I am much, much more comfortable with lending money to the government because the economic situation is not as bad as people feared. Things are looking reasonably okay on the economic side. So we're expecting a recovery to continue. And with inflation, it means that you have a reasonably high nominal GDP growth, which is a very important indicator for government revenue. So we are seeing a very big positive surprise on government revenue, on corporate tax, individuals, VAT, as well as the SACU revenue pool. That's the international revenue we're getting. So the minister also has put it out there and said in his numbers he shows the deficit goes from 11 billion to 9 billion to 5 billion to 2 billion. That's in his numbers. So in 4 or 5 years' time you could have a balanced budget. So I'm not saying it's going to happen that way, but it makes it much more comfortable for us to lend the government money now. So the risk of default, in other words, that the government cannot pay you, is very low in our minds. A lot can still be done if there's another crisis.
Then may I answer the question of on the brokerage and why you need to go through a broker? I think with government bonds, you're not limited to going through a broker. You can actually, I think when they send out the invites, Bank of Namibia, there's actually like a fax number there. You can go and submit your bid in person at the Bank of Namibia. But with a broker, it just gives you, it's that ease of access. That someone is there, they can do it for you, because certain financial products or assets, you need like certain infrastructure to buy them, certain accounts, settlement accounts where these things are going to come. You don't just buy it and it sits in your checking account, you see. So they already have these infrastructures in place for you to come there, and they can do it at a cost, of course. So they make the access easier. I think stocks, shares, if I'm not mistaken, you do need to go through a broker. Floris, please correct me if I'm wrong.
What you said about infrastructure is important, because the Namibian Stock Exchange or the Johannesburg Stock Exchange, whatever, consists of its members. So the members of the exchange are the stockbrokers. So if you want to trade Namibru's shares, it needs to go through the exchange so that the share registry can also be updated to register you as the new owner of the stocks. So there's a bit of a bureaucracy that's built around the whole share trading setup, but it developed over time into the most efficient sort of setup. There are companies that you can buy shares over the counter, as they call it. So that would be unlisted companies. A company that's not listed on the stock exchange.
Gondwana. I think Gondwana, you can go buy Gondwana shares over the counter. Those are for sale right now, for example.
So then that's a direct approach. So it happens. What you mentioned just now about lending money to corporates when one of your funds, when you talk about it, that's all. Most of the time, that's how businesses start. The people borrow money from their family first to start a business, and then they grow, and then they become more public, and then they go to a listing. So listing is usually when you want to raise more capital than what you can gather yourself. So yeah, it's a whole sort of daisy chain that developed over time.
Are there any more questions? So we'll be taking one more question. And then
yes, so let's do two more. There's one on social media, and then hopefully we can round off.
Good morning, and thank you for the opportunity. I just wanted to ask about cryptocurrency, because it has been popping up quite often. Is it legal, and perhaps how can one participate or buy shares through asset managers, or how can one acquire crypto shares?
Unfortunately, I'm a dinosaur here, so I don't believe in crypto, so I'm not the guy to answer. Over to you.
As someone who's invested in crypto, I would not advise. It's very risky. unfortunate. I wouldn't advise you take that approach. I do not think there are asset managers that offer cryptocurrency as, and I'm speaking under correction here, in Namibia.
Locally,
Not
no.
locally.
Yeah. There are various platforms that you can just partake. I know there's Binance. You can buy through Binance. Something that will give you a crypto exposure, and this is on easy equities, rather investing in a crypto index. So it's basically like a, I speak under correct, it's a unit trust for cryptocurrency specifically, if I can sum it up. So yes, it's still risky, but it isn't as risky as investing in a specific cryptocurrency directly. Sure.
Yeah, no, cryptocurrencies are very volatile, and certain countries, they aren't regulated. I don't think we have fully regulated them in Namibia or have an act around that. But I know in South Africa recently they did recognize cryptocurrency as a financial instrument that they're now attempting to regulate. So I think the most common use of cryptocurrencies I've seen is more for speculative purposes. It's not a long-term investment really, because there's not really economic fundamentals behind it. It's driven more by
the social mood.
Yeah, the social mood, the mood, a tweet by Elon Musk or something. So the risks are very they are broad, and so you find people just climbing in there when they see, oh, the price dropped to 10,000 from 60,000 for a Bitcoin. It's time to buy. But it could go down again to 5, or it could increase to 50. So those are the guys who have very high risk appetite or tolerance who usually buy those. So personally, I'm not invested in any cryptos, but more conservative for a guy my age. But yeah.
Thank you, Tim. We also have another question over here.
Good morning. Thank you for the opportunity. Sorry to take you back. I would like to ask basically on the unit trust. For example, as a student, as I am, and I would like to invest in unit trust, like who do I approach? What are the requirements, and how do I go about it, basically?
Okay. May I take this one? Okay. I think you can approach one of our client service consultants. If you go to our website, for example, the contact details are there, and the address, so you can come into Capricorn Asset Management, for example, or any other asset manager. They will explain the products to you. By products, I mean the different type of unit trusts and its risks to you very clearly. Usually there is a minimum investment amount. I think when I joined it was 1,000, then increased to 75,000. It's a bit much. Saying you are a student.
But if you do 1,000 a month,
yes,
you don't need the 75.
Oh,
Yes.
okay. Yes, you
No,
can
you don't
also
need the
commit to
75.
doing what do you call this? A debit order kind of situation. Then once to open your unit trust, and then once you're invested, you then have exposure to that asset class, and then every now and then you must just come again and view your investments and see whether it's what suits you.
So we can't do everything online from the outset, yes? So you can, the first order of business is go to the website, nacam.com.na, and start there and see what's there. And I think you do need to visit the office or a bank branch to do the paperwork, which is a bit of a pain to start off with, but once you've done it, then it's done. Because of the fact that the financial industry are so heavily regulated, we've got a lot of compliance that we need to do, and we need to have proof of a lot of things.
Yes.
So it is a bit of paperwork. Sorry about that, but start with the website and go from there.
Just to add on, Floris, so with the paperwork, it's mainly 3 documents that are required. So it's your proof of source of funds, your ID, and 3-month bank statement. And then after that, the service consultants will take it away.
Thank you for that, Elina. Can I ask that the team keeps the answers very short? We have two more, I believe, two more questions. We'll take the lady over there and then the gentleman over here.
Okay.
Is it on?
Is it Yolanda?
It's Yolanda.
I just wanted some clarity on the monitoring and rebalancing step that you just touched on. Perhaps maybe you can talk me through a scenario what rebalancing is. Does that mean that money has to be moved into another fund, or yeah,
Okay.
just wanted clarity.
Yeah, so the monitoring and rebalance step, it's quite important. So maybe initially, if you had opened or built your portfolio, you would have had a little bit more of an assertive portfolio, for example. And as you grow older, you know, you're still making your regular deposits into your investment account, you know, you're saving. Your needs may change, for example, and your risk tolerance may change, which means your portfolio, the amount of risk in it also needs to change along with that. You know, it's a dynamic thing. It's not like a point in time. So it will essentially mean that you will, you know, have less exposure, for example, to equities and more to bonds and so forth. So, and you just need to do it regularly and make sure. And I think another way, a reason for doing it is also if you keep up to breast to the news and you know ongoing you know economic situations and so forth, you can then say, oh no, COVID is coming, I should reduce my equities because you know there are companies like retailers in there and people maybe will stop going to the shops or something, or went to the shops a lot less, and that will hurt your investment, you know. So it could be based on a forward-looking prediction, basically. So if you think, for example, bonds as an asset class, if your advisor says, oh, these are poised to do very well, you could then increase your investment in the specific asset class. That could also be another reason, yeah. Right.
But I must say rebalancing also happens in the funds themselves. So let's say, for example, Premier Fund is one of our funds. It is a reasonably conservative, moderately conservative, diversified fund. So it has all the asset classes in it. And then the portfolio manager would from time to time rebalance the asset classes back to the original percentages, or would overweight this, underweight that. So that also happens within the fund. So if you're happy with Premier Fund, then you don't have to worry about it, because the fund has its risk profile that it actually complies with.
Last question.
All right. Good morning. All right. My name is Prince Junius, and I'm also a PFA. So I just would like to take this chance now to validate this from the gurus. So would you guys advise a potential client to invest in a short-term or a long-term basis, and why? So given the high inflation that we are in right now, or would one wait for economy robust? Yeah, thank you.
I think it comes back to your position, yeah?
Yeah.
You evaluate your own position and the goals you want to achieve. Yeah. If you want to save, your goal is to make a quick buck, and you take a chance, and your long-term horizon is until after tea, where crypto brought us to, then that's it. But if you want to build wealth for your lifetime, or for your dependents, or for a specific need or retirement, then you have to have a long-term perspective. And then it comes back to the example that I mentioned, where do that, you know, do the skilpad thing, the tortoise. You know the story about the tortoise and the hare. So do the tortoise thing so long, so that you know you've got your plan, and then you do other stuff with some money, that you extra money or something that you are prepared to lose. But don't do everything in a very aggressive manner if you want to build actual wealth over time.
Yeah, no, I think it's a very big function of your investment goals. Where do you want to be? What do you want to reach? If you want inflation protection, like you mentioned now, you're correct, it's a high inflationary environment. You can invest in a unit trust that has a lot of inflation-linked bonds. So that's also a type of bond, a financial product, and that is indexed to inflation. So if inflation increases by so much, your return is always will increase by that much and some. So you have you're protected from inflation. So, but yeah, it is largely a function of your own goals. Yeah.
Okay, thank you so much. I think that speaks to, if you don't mind if I come up here, that speaks to Johanna Kambala's question or statement on our pockets are becoming more and more empty with all these hikes in interest rates. So I think that was touched. Yeah. Okay. I have a question here online as well. And it says the elephant in the economy is medical costs and inflation. NAMFISA estimates 18% of Namibians belong to a private medical aid. That's 18%. Yeah. Premiums are high and unaffordable for most pensioners. And the question is, what investment solution would you advise to save towards future medical insurance?
I think it's a like we are saying, it's a goal that you might want to set up for yourself when you have got enough time left before retirement to say, I would like to create an asset that would pay my medical insurance when I retire. So 10 years before you retire or 15 years, you buy a rental property and you pay down the bond on that rental property by the time that you retire, and then the rental on the property can pay your medical insurance premium. Let's say it's 5,000, you get that. So the whole principle is to build assets that will provide income when you need it, and where you foresee that you could have a shortfall.
So Floris, it all ties down to defining what you want to accomplish. So if in 10 years' time I want to be able to afford my medical aid premiums, then I need to decide now what would be the best investment and what should I buy and invest in right now.
Okay, I don't think I'll be liked if I don't attend to the lady in blue's question. So can we get a mic to her before we close?
Good morning. My name is Elina. I have two questions. The first one is to bring you to the unit trust thing. I just want clarity on the difference between a unit trust, a mutual funds, and an exchange-traded funds. Do we have that? That's a follow-up question on the first one. Do we have exchange-traded funds, like sort of things in Namibia? And then the other one was derivatives. Do we practice derivatives in Namibia?
What derivatives?
Yes, derivatives. Do we practice them here in Namibia? Thank you.
Yes.
Okay. First, unit trust and mutual funds. They are very similar in that they are both pooled investment vehicles. That you gather the money of all your investors, and you invest it in a specific asset class or according to a given mandate. Then your ETFs are a little bit different because they are traded. So can call it the share of the ETF is traded on the exchange, where generally your unit trusts and mutual funds not so much. And with your ETF, I think the price, can fluctuate of that share in the day depending on how it trades and so forth. But it too also does have a mandate which is now to give it its identity, whether it's ETF that is invested in equities or bonds or cryptos. So I think that ETF market is very diverse when it comes to the different type of products that they offer. Generally, even more than like unit trusts, because they can offer you an ETF that will just short everything, short the market, and so forth. So those are ETFs.
We got a few ETFs on Namibia.
We do, yeah.
Listed on the exchange. One is a bond ETF. So if you want to get exposure to government bonds, and then we have got ETFs on gold, platinum, and something else. So we do have ETFs, but the Namibian market is generally very illiquid. Not much trading on the exchange itself going on. So I would maybe, from my point of view, typify the difference between an ETF and a unit trust. Okay, the ETF is, like he said, is an instrument traded on the exchange. People trade the instrument. So if you want to get out of it, you sell it on the exchange to a buyer. The unit trust is, we stand behind the unit trust as the asset management company. So that if you want to withdraw your funds from the unit trust, we buy your units back. So you get a guaranteed buyer for your units, and your investment is very liquid. That's one of the basic differences between the two. So I think mutual funds is really also unit trust. It's just an overseas name for a unit trust is a mutual fund. That's more or less the difference. What was the other? Oh, the derivatives.
Derivatives.
We use derivatives fairly extensively in our funds. Usually the derivatives are in the South African market, because we do swaps on fixed income assets, and we do futures on shares. We don't use options that much as such, because that doesn't serve our purposes really. So yeah, we are active in derivatives, but like Shu said, even if you buy a bond directly from Bank of Namibia, you need to understand the instrument very well if you do that. And if you as an individual want to become active in derivatives, then make sure that you understand the nature of the derivative, how it behaves in different scenarios, and what is the level of gearing that you expose yourself to. So by gearing, it means when you trade in derivatives, you actually make use of a funding structure, and you need to pay that funding cost. But usually a derivative gives you a lot more, let's call it a multiple of your fundamental exposure in a derivative. So that is why currency trading is so risky, because people don't realize by how much their exposure is multiplied when they trade currencies. It can be up to 100 times. So just a small move in the currency can wipe out your cash that you put in there.
Thank you. Are you satisfied with your answer? Are you sure? All right. With that, we've come to the end of our Inspire session, the last for the year 2022. Thank you so much to the team. You did a great job. And please don't leave yet. I'm sure there are some people who'd like to ask you questions still. So yes, thank you so much. Say that again.
I'm saying he's welcome to ask questions. Yes. Around the coffee, I hope.
Yes, there are refreshments. There are refreshments outside, so please don't leave without having something to eat. And until next time, take care. Bye.
Every collaboration starts with an introduction, a moment in time where the stars align at the right place, at the right time, and with the right people. It's the connections we make with one another that form the foundation upon which we build our future. Put simply, it's the start of something new. And when we take those first steps toward positive change, toward our hopes and dreams, we treat the connections we make with care. Because with years of experience, we've learned that the path we choose is not nearly as important as those who walk it with us. No matter the end goal, the trust we choose to put in others is the biggest investment we can make for our future. The Capricorn Group has been walking beside dreamers since 1982, connecting them with the right people and solutions to turn their ambition into opportunity. And it all started with an introduction. Capricorn, we are stronger together.